Company law imposes numerous statutory obligations upon directors and officers to ensure that companies operate transparently and in accordance with legal requirements. Failure to comply with these obligations may result in criminal liability, even where no financial loss has occurred, reflecting the importance of maintaining confidence in corporate governance and financial reporting. One important offense concerns the failure to file annual accounts and confirmation statements, annual returns, on time. The timely submission of statutory financial information enables regulators, creditors, investors, and the public to monitor a company's financial position and compliance with company law. Where accounts or annual returns are not delivered within the prescribed deadlines, every director in default commits a criminal offense and may be liable to a financial penalty of up to £5,000. The obligation applies personally to directors responsible for ensuring statutory compliance and cannot be avoided by delegating administrative responsibilities to employees or advisors. A further offense arises where a company officer provides misleading, false, or deceptive information to an auditor, or deliberately fails to provide information or explanations properly requested during the audit process. Since auditors rely upon management representations to verify financial statements, the integrity of corporate reporting depends upon complete and truthful disclosure. Criminal sanctions therefore reinforce directors' duties of honesty and cooperation throughout the audit process. The legislation also criminalizes acting as a director while subject to a disqualification order under the Company Directors Disqualification Act 1986, CDDA 1986. Individuals who knowingly manage a company despite being disqualified may face an unlimited fine and imprisonment of up to 2 years. This prohibition protects creditors and the public by preventing individuals previously found unfit to manage companies from continuing to exercise corporate control. Failure to prevent tax evasion. The Criminal Finances Act 2017 introduced a significant corporate offense relating to the failure to prevent the criminal facilitation of tax evasion. The legislation reflects the increasing international emphasis on corporate responsibility for the conduct of employees and associated persons acting on behalf of organizations. Rather than requiring proof that senior management participated directly in tax evasion, the offense focuses upon whether the organization failed to establish adequate preventative procedures. Under the Act, a relevant body, defined as a company or partnership, commits an offense where it fails to prevent an employee or associated person from facilitating either UK or foreign tax evasion while acting on its behalf. An associated person may include an employee, agent, subsidiary, contractor, corporate entity, or another individual providing services for the organization. The legislation therefore extends corporate responsibility beyond direct employees to encompass a wide range of business relationships. The offense applies to both UK and non-UK organizations, demonstrating the extraterritorial scope of the legislation where UK tax interests or UK business operations are affected. Importantly, liability arises from the organization's failure to prevent facilitation, rather than from committing tax evasion itself. This approach encourages businesses to implement effective governance systems and compliance cultures designed to prevent unlawful conduct before it occurs. The principal statutory defense is that the organization had reasonable prevention procedures in place at the time of the offense, or that it would have been unreasonable to expect such procedures under the circumstances. Appropriate procedures may include employee training, risk assessments, internal reporting mechanisms, due diligence processes, and effective compliance monitoring. Failure to establish adequate controls may expose the organization to unlimited financial penalties together with significant reputational damage, even where senior management had no direct knowledge of the misconduct. Fraudulent and wrongful trading. The Insolvency Act 1986, IA 1986, distinguishes between fraudulent trading and wrongful trading, both of which impose personal liability upon those responsible for corporate misconduct during periods of financial distress. Although both provisions protect creditors, they differ significantly regarding the level of dishonesty required and the persons who may incur liability. Fraudulent trading, governed by Section 213 IA 1986, occurs where the business of the company has been carried on with intent to defraud creditors or for any fraudulent purpose. The offense requires proof of dishonesty, making the evidential burden relatively high. Liability extends to any person knowingly involved in carrying on the fraudulent business, including directors and other participants. The case of R.V. Grantham illustrates this principle, where ordering goods on credit while knowing they would never be paid for constituted fraudulent trading. The consequences include an order to contribute personally to the company's assets, disqualification for up to 15 years under the CDDA 1986, together with criminal fines and imprisonment. Wrongful trading, under Section 214 IA 1986, does not require proof of dishonesty. Instead, Liability arises where, before liquidation commenced, a director or shadow director knew or ought reasonably to have concluded that there was no reasonable prospect of avoiding insolvent liquidation, yet failed to take appropriate action. The provision therefore imposes an objective standard of responsible management during financial distress and encourages directors to protect creditor interests once insolvency becomes inevitable. Directors may avoid liability for wrongful trading by demonstrating that they took every reasonable step to minimize potential losses to creditors once insolvency became apparent. This defense was recognized in Re-Produce Marketing Consortium, emphasizing that directors must actively protect creditor interests rather than continue trading irresponsibly in the hope that circumstances will improve. Where wrongful trading is established, directors may be ordered to contribute to the company's assets and may also face director disqualification for up to 15 years. Unlike fraudulent trading, however, wrongful trading does not ordinarily attract criminal sanctions because dishonesty is not an essential element.